Howdy, y'all. Welcome to another Beverages with Brie. Today's beverage is ice cold water. It is hot as the blazing sun out there. It is the middle of the summer, I guess, and we've hit record heat. So, yay, I guess. Today's Beverages with Brie is going to be another one where you're going to see more of my presentation and less of me. Sorry about that, y'all. I know you guys just love seeing my mug, but today we're going to go through some slides. This is a little bit of a longer one. So if you've got any questions, if you want to kind of talk through this, don't hesitate, give us a call. But this is a mid-year outlook for 2026. And I got this from AssetMark, our new back office. We worked on it. They sent it to me and then I kind of modified it for what I thought fit us best. So let's get going. So we're going to talk about the mid-year market outlook and what we believe matters most for investors as we move into the second half of the year. So first thing we got to take a look at and we're going to talk about is the market. We're going to talk about the mid-year market outlook and we're going to talk about some thought leadership, some things that I've heard from economists, other industry people, and just kind of where they think the market is going based off what we have seen so far. So the first half of 2026 has been strong for the markets, but it's not just been strong with a linear straight line. We know that's not how the market works. We can see the dip in March. The S&P is up year to date, but unlike the past couple of years, this rally has broadened beyond just 7 major stocks. So it's not just the magnificent 7 that's helping us with this right now. International developed markets have also posted really solid gains this year, and emerging markets have been a standout performer as well. So that broader market participation is encouraging because the healthier the markets are usually not just dependent, healthier markets are usually not just dependent on a handful of companies to sustain growth. So the biggest thing that you need to be able to take away from what you see right here is today's markets are being driven by much broader set of companies, sectors, and regions. It's not just all the US. It's not just all big tech companies. And that is really good for long-term investors. And it reinforces the values that we believe in staying diversified rather than worrying about chasing last year's winners. This is really, really good for all of you because you guys are all in well-diversified portfolios. So yay, good for us. Now, we've begun the year with a PASS philosophy. And what does PASS stand for? It's policy, geopolitics, AI, and stimulus. And now that we've started the pass, now we're looking at pace, more pace, policy stability, AI investment, consumer resilience, and earnings growth. So we've been in pass and we're moving into pace. That's what we're focusing on for the mid-year and end of 2026. So fiscal stimulus is being offset right now by higher energy prices. We've all seen that, especially if you bought gas recently. And we haven't seen any fiscal stimulus this year. The Fed's been kind of on hold. So you haven't heard about any interest rate cuts. And as a result, it's the fundamentals. It's truly what stuff is worth that are driving the outlook for the second half of 2026. So let's talk about that theme 1, the policy and geopolitics. We know I can nerd out about this, so I'm going to try to keep it pretty easy and pretty light. Okay, at the beginning of the year, we were all worried about the T word, tariffs and geopolitics. And we're still, to a certain extent, worried about geopolitics at the moment. Both are still, tariffs and geopolitics are still uncertain, but they've been less disruptive than we all initially feared. Nothing's gone away necessarily, but tariff rates have moderated from their highs. They're not as high as they once were. Oil prices have somewhat normalized. This past week, they've gone back up, and they will do that while we're still in a political conflict, but they're not as high as they were at one point in time. And markets appear to be kind of treating this as normal now. They're kind of looking at it as things to monitor, but not reasons to abandon long-term discipline. So biggest thing to know here, though, is we're not declaring victory. Trade talks still continue to this day. Middle East ceasefire doesn't exist, does exist. I don't know. It's hour by hour right now. So all of these are fragile risks worth monitoring. But that's just what they are, fragile risks worth monitoring, not reasons we should change a portfolio. And this chart illustrates an important lesson from the past 2 years. Markets repeatedly distinguish very well between uncertainty and lasting economic damage. In 2025, which seems like a lifetime ago, but was only last year, investors reacted sharply to the announcement of the sweeping tariffs. Remember, the tariffs were announced. Everybody was super, super worried about it. And as policy evolved and the economic impact proved more manageable than initially feared, it all worked out. And so this year, we've got more military conflict involving Iran that has been pushing the volatility forward. But as we've looked at that and the markets have kind of taken that in stride, it doesn't seem to be affecting them as much as it would. Now, that's not to say everything's gone away. Trust me. Negotiations remain active. It's super important. Additional volatility is always possible. One never knows when we're talking about geopolitical issues like that. Let's talk about something that we understand way more than geopolitical issues. And by something we understand way more than geopolitical issues, I want to talk about AI, which if you don't understand AI, that's fine. Welcome. Most people don't. AI has been an economy-wide investment story. It's not just a technology story. It's not just a ChatGPT story anymore. It is becoming a broader economic investment story. It's going to touch our infrastructure. It's going to touch how businesses are formed. It's going to touch productivity and capital spending. So it's not whether AI recreates any prior technology boom, because it's not going to be the same technology boom we've seen in the past. It's about whether it can meaningfully improve our productivity as humans over time. And productivity surprises can change economic outcomes. If we're more productive, then we can be more profitable. And so this is the major long-term question everybody's watching, including me. So these trends, all looking at this, looking at power, looking at money spent on computing and data centers and power, these trends are suggesting AI is beginning to diffuse throughout our whole economy. And I think we're starting to see that. The best case in point I can use is members of my own family who are Luddites, who hate technology, who don't know how their cell phones work, are using ChatGPT to redesign their homes. You know who you are, and I love you. So the previous slide talked about how AI investment is spreading across the economy. This slide shows how it matters. So companies that are making meaningful investments in AI are starting to see the business benefits of it. Firms with high AI spending have generated substantially faster revenue growth than those who are making an investment in AI. Basically, if you try to ignore AI at this point in time, you may end up going the way of the dodo bird. AI is going to make your business different. It's going to give it a competitive advantage. It's not an expense. And that's kind of what people are starting to see. And the big technology companies are investing aggressively to build infrastructure that supports this transition. We're seeing it here in Texas. How many cities are fighting about data centers right now? So we've got bond issuances from these companies and cities. This is cutting across just investments by companies. And AI adoption is still, believe it or not, in early stages. So we're starting to see the economic winners emerge, and it's reinforcing the belief that AI is more than just a short-term market theme. It's not. It's becoming a driver of corporate earnings and competitive advantage. And this is really kind of interesting. In 1993, economists underestimated the internet. So this is a really good story from the tech boom, that major innovation cycles can materially reshape economic expectations. So 1993, productivity forecasts were relatively modest. They didn't think that productivity was going to increase that much. But by 2000, actual productivity growth came in far stronger than what we expected it to because of technology adaptation across the economy. Stronger growth also contributed to better than expected fiscal outcomes and debt to GDP ending the decade materially lower than many projections had anticipated. Okay, I'm not saying AI is going to be the 1990s again. I promise. We don't all have to go back to the same haircuts and what we wore in the 90s. But what this does say is we can't ignore and we can't underestimate a technology boom, especially not one that could change the entire world. We got to pay attention to this stuff, guys. So let's talk about us. Let's talk about the consumer. We're pretty resilient. First of all, hiring has stabilized. The labor market is improving, and it's an important foundation for our overall economy. Hiring has slowed from where we saw it coming out of the pandemic, but there's a feature of normalization. It's showing more normalization than deterioration, meaning it's not falling apart. It's just becoming more normalized. We're not leaving a pandemic again. Payroll growth has averaged about over 100,000 jobs per month so far this year. So we've got employment expanding without creating wage pressure, which is awesome. Now, some recent reports have also been somewhat firmer than many economists expected. What does that mean? That means employers are remaining reluctant to reduce headcount. They don't want to fire people despite ongoing policy uncertainty. So we've got a steady labor market right now, and we want to keep it this way because this steady labor market supports our household income growth. It supports consumer spending. So as long as employment remains healthy, the broader economy it's good for the broader economy. What is it? It's good for the gander, it's good for the goose. Same situation here. And that means our consumer, that means you and I and anybody who's gone to the grocery store or gone shopping, we're a key support of this economy. But the picture is becoming more differentiated across income groups. Overall spending growth remains healthy, but the higher income households are continuing to lead. Strong balance sheets, rising asset values, those account values going up, and higher incomes, if you're getting a pay raise, have allotted to consumers maintaining spending at a robust pace. By contrast, or the problem, is our lower and middle income households. They're facing more pressure right now. As the chart on the right shows, spending growth is now outpacing after-tax wage growth for these groups. So they're relying more heavily on savings or credit to sustain their consumption right now. And that's not good. Now, this doesn't point to an immediate pullback in consumer spending, unfortunately. But it does suggest the consumer is becoming increasingly separated. The high net worth is kind of pulling away from the middle class now. And we need to continue watching this. We need to see if these pressures broaden or remain concentrated among more of the lower income households. And then household wealth continues to support consumer spending. So one reason consumer spending is strong is household balance sheets are growing too. Household wealth has risen meaningfully over the past several years. We've made lots of money in the market over the past several years, not just in our financial assets, but also in our home values. And that increase in wealth has helped offset lower personal savings rates, allowing more consumers to continue spending even if they don't necessarily have the cash, and even with higher interest rates. At the same time now, households hold a record share of their financial assets in equities. There's more people that invest in the market now than ever. And that's been a tailwind as markets have performed well. But it also means consumer confidence and spending could become more sensitive if we have any type of correction in the markets. I mean, that's the problem with having so much of our wealth tied up in our home. It's hard to get out of our home. You have to sell your home. So right now, wealth effects remain supportive, but it's another area that we got to pay attention to. And our fourth theme, earnings growth here. So while investors also often talk about global equities as if it's just one asset class and one country we're talking about, earnings outlooks vary meaningfully across regions. So we've got a couple of different regions we're looking at here. We're looking at the United States, our international developed markets. That includes Japan, the UK, France, and Germany. Those are our developed friends. And then looking at emerging markets. This is Taiwan, South Korea, China, India, Brazil. And you can see earnings growth estimates by region are vastly different. In the US, earnings growth remains healthy, We've got that resilient economy. We've got an AI investment in technology. International developed markets are also seeing improved earnings momentum right now because of stronger industrial activity, financials, and more supportive macro backgrounds. Emerging markets are a different story right now. Earnings expectations have accelerated sharply this year, driven in a large part by the technology leaders that I mentioned, Taiwan, South Korea. So that's where a lot of our tech comes from. And we've got improving fundamentals in other markets. So that really has helped the overall world. So the key takeaway in this slide before we move on to the next one, because I got trigger happy there, is that today's global market isn't being driven by one country or a synchronized earnings cycle or one thing. It is each region is having their own set of economic growth and sector specific drivers. And they're getting opportunities for investors who maintain a diversified global exposure. Well, congratulations, you guys maintain a diversified global exposure. So this is good for all of us. One of the most common questions I get asked, though, is this the dot-com bubble again? Now, first of all, the other question I get asked is, do you remember the dot-com bubble? Yes, I do. And there's similarities in investor enthusiasm. There's similarities in the phone calls I got about the recent IPO that I remember also hearing about during the dot-com bubble. But there's one important difference. So the chart on the left shows this year's market gains have been driven. So what has caused the market to go up? It's by earnings growth rather than expanding valuations. The market has gone up because of earnings. On the right, technology profits have kept pace with stock performance. So the tech sector isn't just running away versus the S&P 500. That's what happened in the late 90s. That's when valuations went way ahead of fundamentals. So this is important to say that it's not the same thing. Now, that doesn't mean valuations don't matter. They matter. But AI leaders are generating substantial earnings and cash flow, making this very different than the tech bubble. This is not the tech bubble. So let's put this together in English. We've got some good things. We've got some neutral things. We got some bad things or some things to be cautious of. I like this little chart. So the fundamental drivers of growth remain intact. The market's doing very well. The labor market continues to support household income. Corporate earnings remain healthy. All good signs for us. AI investments expanding beyond just the tech sector. And consumer spending is proving resilient, more resilient than many expected. At the same time, we have to be cautious of certain things. And the biggest thing that we have to be cautious of right now is inflation. And what underlines inflation is tariffs, energy prices, and geopolitical developments. All of those things could hurt inflation even more and could hamper the growth. So that's something we always have to be cautious of. So we've got some strong economic growth, but we have to be cautious of the areas that aren't as strong right now. And we will see periodic volatility. I'm promising. It's not going away. So here are inflation's come down from what it used to be in 2022, and progress toward the Fed's 2% target has slowed a lot lately. The biggest upward pressures today are coming from energy volatility, shipping disruptions. Yes, that's still happening. And higher input costs tied to, geopolitical tensions. We don't all get along. And these factors are keeping inflation elevated. Importantly, the current environment differs meaningfully from 2022. Wage growth has moderated, hiring pressures have eased, and shelter inflation is gradually slowing. How much are interest rates on homes? So it's helping offset some of the energy-driven inflation pressures. So I think the Fed is going to be patient rather than worry about aggressive tightening. I think the Fed's going to kind of watch the markets and take a more patient approach. And that's really probably what they should do. The markets have shifted from expecting multiple rate cuts this year to just looking for a higher for longer environment until inflation starts showing that it's come back down. So big thing I want to talk about. Something else I'm hearing is the market's at an all-time high. Why would I want to invest now? Why are we rebalancing during an all-time high? First of all, new highs have historically led to more new highs. History suggests the opposite. New highs aren't unusual. They're more of a natural feature of a long-term bull market. Since 1957, more than half of all market highs were followed by another new high the very next trading day. Within a month, that figure rises to more than 90%. So that doesn't mean we're never going to get a pullback, though. That doesn't mean volatility is going to disappear. It's not, I promise you. Volatility is a normal part of investing, and corrections can occur at any time. But what we need to be aware of is not to be fearful of these new highs. These new highs right now are historically showing us strong underlying fundamentals. So we don't necessarily have to take the Eeyore approach. I know that that's helpful for some people, but new highs are showing us it's a reason to stay disciplined, not step aside. And one of the biggest shifts we've seen this year has been the market's expectation for fewer rate cuts. That may seem negative for bonds. Today's higher yields have changed the investment outlook. They really have. So the chart on the right shows income now makes up a much larger share of total return. Even if the rates were to rise another 1%, the US aggregate bond index would be expected to experience only a modest decline, far less than what investors would have faced when rates were much lower. So rates are not being as volatile as they have been in the past. We are getting more income now. We have greater resilience. So high quality fixed income needs to be in a portfolio, not just to provide us income, but for also for portfolio diversification. We need these bonds. I know some of you don't like having them, but we need them. And they really are a big part of a diversified portfolio. And for the last few years, they're not providing the same protection that across all market environments. But right now, inflation-driven sell-offs like 2022, bonds and stocks declined together as interest rates rose sharply. That's why we believe that we need to have the diversification and have high-quality bonds because of their downside protection, because of the income. But we can't compare them to the stock market. It just doesn't work that way. And we want to make sure we're complementing them with other diversification to help build the portfolios. And that's what we've done. Yay, us. I'm so proud of us. And we don't know exactly which economic regime is going to come next or exactly which asset class is going to win off. We've got some ideas and different asset classes. So when I say that, I mean like large cap, mid cap, small cap. All of those things tend to perform well under different combinations of growth and inflation. So traditional equities and credit have historically benefited from stronger growth, while assets like commodities, gold, infrastructure, treasury inflation protected securities, they tend to provide support when inflation remains elevated. So bottom line, we shouldn't try to position the portfolio for a single outcome. Like, we believe in a diversified portfolio. It isn't about trying to predict what's going to happen next. It's about being prepared for whatever happens next. We're not for prediction, we're for preparation. There you go. So we began the year focusing on policy uncertainty, geopolitical risks, and whether the economy could withstand higher interest rates. Those risks haven't disappeared. They're just not driving the market right now. They're still there. They're just not the most important factors right now. Right now, the market is looking back at fundamentals. Right now, the market is looking back at AI investment. And we are looking at consumers and the fact that they're still spending and how that's affecting the economy. And then growing differences across economic groups. We've got a lot to look at and be happy with. We also have some things to be cautious about. As always, we never want to remove our eye from things we should be cautious about. But we believe in long-term investment outcomes will be driven more by fundamentals than by headlines now. And that will be nice for a change. And it'll allow us all to take a breath if that's possible. We want fundamentals over headlines. Of course, this talks about the indices that I talked about earlier in the presentation. And then, as always, we've got more indices for you to look at here. Here's our lovely slide designed to talk about there's always risk. There's always potential loss of principal. Past performance is not indicative of future, does not guarantee future results, all the good stuff. Bottom line, things have been going well. We've had a really strong year. Do I hope it continues that way? Yes. Can I guarantee that it continues that way? No, no one can. So we have to be watching the market. We have to be staying diversified. We have to rebalance when we need to rebalance, which is what we're working on right now, what we've been doing this week, and protect ourselves from when a correction does occur, because it will. A correction will eventually occur. Thank you so much for listening. Go out and lead an abundant life. Bye, y'all.